Hi, friends. So you're looking at an adjustable rate mortgage. You're hearing that interest rates on the 30-year fixed have gone up, and there's more of a spread now between the 30-year fixed rate and adjustable rate mortgage. So that adjustable rate becomes more of a viable option. In fact, in years past, there has not been a significant spread between the 30-year fixed and the adjustable rate. But as the market is in today's time, there is more of a spread, so that adjustable rate mortgage becomes a little more viable of an option, a little more of a strategic option. Today's video is going to be on really the education behind an adjustable rate mortgage and how it works. It really is not as scary as what most people would make adjustable rate mortgages out to be. They're actually really a good safe bet if you manage them properly. In fact, one option that we used to have was a monthly adjustable rate mortgage. And at that time, I could show you that a monthly adjustable rate mortgage would outperform interest rates on a consistent basis. So we don't have the 1 month adjustable rate mortgage anymore. In fact, the longer adjustable rate mortgage is the one that is more viable, which is a 10-year fixed adjustable rate mortgage, even more so than even a 3-year or a 5-year. And the reality is that most of you won't keep your mortgage longer than 10 years as it is. And there's a chance, we don't want to hang our hat on this, but as we're heading into a market that is more inflationary, and as the inversion happens between the 10-year and the 2-year treasury notes, at that point we could potentially head into a recession. And should we head into a recession, interest rates are going to be lower. They could be lower in the next couple of years, year to two, which then we could look at potentially refinancing into a 30-year fixed if it makes sense. But again, we don't want to hang our hat on that. So let me share with you a little bit of a difference of how the 30-year fixed or how the adjustable rate mortgage works. In our industry, we have slang around adjustable rate mortgages, and we'll call it a 5-1 ARM or a 10-6 ARM, 10-1 ARM, 3-1 ARM, whatever that is. That first number that we talk about, how long that fixed rate portion is. The second number that we look at is how long of a adjustable rate period happens thereafter. So for instance, if I'm talking about a 10-6 ARM, then your interest rate is going to be fixed for 10 years. After that, it will adjust every 6 months thereafter. If I'm talking about a 5-1 adjustable rate mortgage, your interest rate is going to be fixed for 5 years. And then every year thereafter, your interest rate will adjust every year thereafter. So again, 10-6 ARM, fixed for 10 years, adjust every 6 months. 5-1 ARM, fixed for 5 years, adjust every year thereafter. Now, you also have a first adjustment cap. On our 10-6 ARM, our first adjustment cap is 5%. That means that your interest rate could go from 4.375 to 9.375. Please don't leave and shut the video off yet. I've got good news coming for you. So you have that first adjustment cap you want to watch for. How high can my interest rate go to? You also have a periodic cap, meaning that after that first adjustment, your interest rate could go up or down by 5 points, and so 5%. Then your interest rate could go up or down with that periodic cap. So 1 percentage point up or down every 6 months thereafter. Why I asked you not to turn your TV off. The reality is that we also have a max rate. Your interest rate cannot go above the max rate. This is where it starts to get a little more technical. So please don't go to sleep on me. You've got that max cap, you have the periodic cap, now you have the max rate. That max rate is 5% above what the SOFR is, which is the indice that we're tying our 10-6 ARM to. And that's at the time of closing. So today's SOFR rate, it was 0.30. So that max rate would end up being 5.30. It's 5% above whatever the SOFR rate is. Now you may ask me what the SOFR rate is. The SOFR rate is the secure overnight financing rate. That's the indice that we're tying the adjustable rate mortgage off of. Now, with the SOFR rate, we used to do adjustable rate mortgages based upon LIBOR, which is an outdated indice. The LIBOR was the London Interbank Offering Rate. We used to also do adjustable rate mortgages based upon the MTA, the monthly treasury average. A more secure rate history or rate path right now indice is the SOFR, which is, again, the secure overnight financing rate. I hope that makes sense. Again, don't be scared of adjustable rate mortgages. They actually can be more secure and a better option than a 30-year fixed. In fact, when I looked at the difference between the 30-year fixed and the 10-6 ARM, you're looking at a difference of about 0.5% interest rate. And on this specific transaction, it really is a $134 a month savings. Now, because I need to disclose this because I'm talking specific interest rates, today's interest rate that we looked at on this specific transaction, it was a $500,000 purchase price, putting 10% down with a 760 credit score. The 10-6 ARM interest rate was 4.375. The APR was 5.268. Same scenario, $500,000 purchase price, 10% down, 760 credit score on a 30-year fixed was 4.875, and the APR was 5.345. I hope that you found value in this. Really look at the first adjustment cap, look at the periodic rate. Most importantly, between those two, look at the max rate. What is the max rate that your interest rate could climb to? I hope that you found value. Please like our YouTube channel. Please share this with other people. And if you have any questions at all, please just reach out. We're here for you. Thanks. Have an awesome day. Bye-bye.